Today's lesson, we're going to focus our attention now on taxation of life insurance products, okay? As you all know, the death benefit of a life insurance product is tax-free in Canada. So therefore, there's no discussion here in terms of the death benefit. What we want to talk about is what I call the living benefit, which is really more the cash value that's in a policy. As you know, in permanent insurance, like whole life, universal life, and all that, you have two components. You have the death benefit, but you also have the cash surrender value. It is a question of the cash surrender value that we want to address here. In other words, you didn't die, because I said the death benefit is tax-free. You in actual fact are alive, and now you have a tax issue. Now, what happens is, let's assume for argument's sake that you received a statement from your bank, from the insurance company, whatever, and it said that you have $50,000 to pay in your cash surrender value account. In other words, you have $50,000 you can actually access. So the obvious thing is, well, I'd like to get my hands on that $50,000, and that's fine, you can do that. However, there are tax implications here. And this is where we get into the whole question of December 1st, 1982. Something magically happened here where things changed and how products were going to be taxed. So pre-82 situation, we have to look at what was the adjusted cost base. You remember that the definition of adjusted cost base is really what did it cost me to actually buy this product. That's what the definition of ACB is, okay? Is what does it cost me to actually buy the product. So the definition changed, okay, basically on December 1st, 1982, the world changed around. So policies that were last acquired prior to December 1st, 1982 have a different definition of ACB than policies that were issued post-1982. In other words, December 2nd, 1982. So let's take a look at the pre-82 first. And the first thing is we look at non-participating policy. In a non-participating policy, all we're really saying is that basically what the ACB is going to be is basically the premium that you are paying. So let's say you paid me $1,000 a year for the last 20 years, okay? So therefore, for 20 years, that means that your ACB is $20,000. Now, to facilitate this, what you may want to do is make notes here. In other words, take out a piece of paper and follow along with me. Read over the manual as well, but follow along with me, and we'll get through this. So look at this more as a lecture, workshop, rather than just sitting back and listening to me. So in a pre-82 non-participating policy, basically what we're saying is the ACB is strictly the premium. If you paid me $1,000 a year for the last 20 years, then the ACB would be $20,000. So in this example, if you were to cash in your policy right there on the spot, okay, so the difference between the $20,000 and your $50,000, in other words, $30,000, will be considered interest income and will have to be put into your T1, and you will have to pay tax according to your marginal tax rate, or MTR as they call it, okay, your marginal tax rate. Now, if it's participating, it always starts with premium. Okay, it always starts with premium. So once again, let's assume that premium was $20,000 that you paid me, okay? However, during that same period of time, the insurance company sent you a check or basically sent you notification that they gave you $5,000 in dividends. Remember, the participating policies have dividends. So the fact that we have now paid you back $5,000 in dividends, and remember the dividends are a refund of your own money, basically a refund of your own premium. Therefore, that $20,000 now is actually $15,000. So what we're saying is that dividends, in fact, reduce the adjusted cost base. So just review very quickly, non-par is strictly premium. So the difference between the premium and the amount of cash surrender value that's in the policy, that difference, in this case, $30,000, that will be fully taxed according to your marginal tax rate. If, on the other hand, you had a participating policy and you paid me $20,000, but the insurance company throughout that same 20-year period of time gave you $5,000 of dividends, basically a refund of your own money, therefore your ACB has been reduced by $5,000. So now you have $15,000. So it's $15,000 minus your $5,000. So that will be taxed in your, so it's $35,000 will be considered taxable income in your hands, and you'll have to pay the tax according to your marginal tax rate. Okay. Now, post-82, in other words, December 2nd, 1982, the world changed quite dramatically. So here what we've got is, again, on a non-par, it'd be the same thing, premium again. It always starts with premium, remember. Always starts with premium. So once again, let's assume you paid me $1,000 a year for the last 20 years, and now you gave me $20,000. So the exact same example. However, during that same period of time, the insurance company also insured you, obviously, throughout that period of time, and they had to pay a certain premium. In other words, you benefited from this particular premium. So as you died, of course, they would have to pay the death benefit. And so therefore, what they'll do is they will, in fact, deduct the cost of whatever it costs to insure you during that same period of time. And that cost is NCPI, net cost of pure insurance. In other words, what did it actual fact cost us to insure you during that same period of time? So yes, you gave us $20,000. However, you benefited by the fact that we actually, in fact, took some of that money and insured you. So if you died, your beneficiary would receive a whole bunch of money, basically tax-free. Well, you need to deduct the NCPI. So NCPI reduces your ACB. So let's assume again that your NCPI was $5,000. You gave me 20. I gave you back basically $5,000. So therefore, on a non-participating basis, your ACB is $15,000. Now, if you look at pre-82, it would have been $20,000. Post-82, because we have to deduct the NCPI, is $15,000. Okay, so therefore, obviously, you're going to have a bigger tax problem at post-82 policies than you have pre-82 policies. If it's a participating policy, in other words, a par policy, the matter is compounded even further because, again, we start off with premium, and once again, we add a $20,000 premium, let's say, that you pay me. I gave you $5,000 in dividends, remember, that $5,000 in dividends that I gave you here, okay? But I also gave you $5,000 in NCPI, okay? So therefore, now really only $10,000 is going to be your ACB. So therefore, on your ACB is 10, the cash surrender value is $50,000. So the difference between your $50,000 and your $10,000, in other words, $40,000, will have to show up on your T1, and you're going to have to pay tax on that. So basically, to summarize this thing is that pre-82 is strictly non-par, is strictly premium, and that's it. If it's participating, it's premium minus your dividend. Your dividend reduces your ACB. Post-82, it's the exact same thing as pre-82, except that you have also one more variable, which is your NCPI. So on the exam, they will give you what the NCPI is. So you don't have to figure out what this is. All you have to remember is that the NCPI reduces your ACB. So therefore, it makes the product more taxable. The income more taxable. So basically, in a nutshell, what we're really saying is that the difference between the ACB and the amount of money you take out will be taxed. So the key here is to be able to figure out what the ACB is, pre-82, post-82. And remember that any amounts of money, so if you didn't take out the entire amount, you only took out $5,000, let's say, and that $5,000 was more than your ACB, you're going to have to pay tax on that $5,000. If you only take out up to your ACB, there's no tax implication because your ACB is your cost, so therefore it's just a return of your own money. But any amounts of money, whether it be $1, whether it be the full amount, any amounts of money you take out above your ACB, that will be reported as income. The insurance company will send you some kind of a report system on T3 or T5, basically saying this is what you have to report in your when you do your T1. So it's very important that you establish what the difference between ACB is pre-82 and post-82. You should also be aware that we're not only talking in terms of actual cash to policy in other words, withdrawing any money or anything, we're also talking about loans. So you can't escape this. So whether you in fact take out money, in other words, make a withdrawal from your plan, or whether you borrow the money from the insurance company, it's the exact same situation. So what you see here actually works both ways. So if you didn't bother, in actual fact, taking out the money, but you decided instead to actually borrow, let's say, the $40,000, that $40,000 will be taxed. Anything above the ACB will be taxed whether you withdraw the money or whether you borrow the money. It doesn't really matter. The same formula will kick in. So basically what we're saying is that the insurance company has what they call an MTAR line, a maximum taxable actuarial reserve. And as long as you stay within that MTAR line, the money is exempt. In other words, the product is a totally exempt product. You don't have to worry about reporting it T3 or T5. You're never going to see that. However, the moment you take out money out of that plan, whether you actually withdraw the money or whether you in fact just borrow the money, doesn't really matter, and that money is more than your ACB, whether it's pre-82 or post-82, you will in fact have a taxation situation. You're going to have to report that on your T1 that you file every year with Revenue Canada.